So my name's Buck. My background prior to getting out on my own was in finance. I started my career at JP Morgan and BlackRock in New York City, working for a small developer. When I left BlackRock, I started my company, Human Capital. It's a real estate development and consulting firm. And similar to what Mike was just saying, I believed that I was a real estate developer and consultant before I was a real estate developer and consultant. I left BlackRock, and the first thing I did was starting to email private equity and venture capital groups just offering financial modeling and pitch deck services. I had nothing. I was doing carpentry in Boulder, Colorado, and I was emailing these people like I had an actual company. Pretty quickly, I started to get opportunities, and one of those first clients ended up being a partner on 2 of my deals to date. Over the last 8 years, I've raised over $220 million between my projects. I have 4 principal projects around the country. Today, like I said, I want to give my background. I'm going to talk about how I've structured my company, and then we'll get into capital raising, and that's really where I'll just open it up mainly to Q&A. One of those first clients, the client that has ended up becoming a partner of mine on multiple deals, it's called Aligned Ventures. It's a venture capital fund out of Miami, and it's 2 partners, and I just emailed them. I had a soft connection with one of the partners there. I told them what I was doing. I said I was trying to get into development, but I was offering financial modeling for the time being. They were starting to do real estate, and I started to model some of their deals. But what I mainly started doing with them was raising capital for what are called SPVs, single purpose vehicles in the venture capital space. Over the course of 18 months, we did 17 deals together. We were doing about a deal a month. We raised $175 million. It was the 2 partners and myself. My job was modeling, putting together materials, talking to investors. Their job was relationships. I also handled all the back-end work of getting investors signed, getting wires in, getting the deals funded. That was really where I cut my teeth. We moved really fast. We would get a deal in. Basically what we were doing, we were buying tranches of shares. It's not real estate related, but you'll see why this is important. We'd find tranches of shares in private companies. Say a CFO at Airbnb 2 years before they went public wanted to buy a lake house. He'd go sell some of his shares. We would buy them and go raise money from this group of LPs that we had. So the job was both finding those deals, packaging those deals, bringing them to market, having calls, marketing those deals, and then also building up an LP base, as Mike was just talking about, in advance so that when we got those deals in, we were ready to bring them somewhere. So over the course of that time, like I said, $175 million, it was me, Ben, and Grant. We grew 150 investors. Most of them were their personal connections. When I left, we were at 600 active investors that we were going to with every single deal. And over the time, building this relationship with Align, part of the time it was COVID, and I was traveling. I built a truck camper. I put like a hardcover on the back of my pickup truck. I was driving around the Western US. I was working from coffee shops. When I was doing that, I personally had a need for somewhere that I could stay, sleep, and work. And I was in Bozeman, Montana. I saw a piece of land for sale, and I had an idea for basically an upscale campground that had co-working, F&B, wellness amenities, a place for people like me and the people I was traveling with. I was sort of caravanning around with a lot of young people working from their cars. And I took this concept to Align, and I pitched it to them. And they basically said, if you can get this where it needs to go, we'll help you raise the money. So I took my camper. I went out. Well, really, I spent 6 months looking for land, looking for a market, narrowed in on Arizona. The reason we picked Arizona is because they had a family office connection there that was big in land development. They were a wealthy family, but they made their money through land. And I was having so much trouble finding a market, understanding the zoning across 12 different states across the Western US. I at least knew I wanted it to be in the West. I drove down to Arizona, looked at a bunch of markets there, honed in on Sedona. This is a multi-month process of sort of like working down the chain, and then continued to package this deal, put it together, took it to the family office, raised $2 million, bought a piece of land in Sedona, and started the development of what is now Oxedo Sedona. That was my first deal, and that was when I went out truly into hotel development. So about a year after I left my job. And over the course of Sedona, which is still under development, it will be the last project that I open, even though it was the first I started. That's just kind of how this goes. I was talking to some people earlier. All these deals, multi-year deals, some of them longer than others. But I found land, raised the money, bought it, brought on a partner, Lauren Warner, who developed a Willow House in Texas. It's a very similar concept. I met her through a friend. That changed everything. She really leveled it up. Over time, I moved on from campground to more like micro resorts, like tiny homes, basically, like you see a lot of people doing. She came in, her place Willow House is incredible. She took it to sort of this next level of luxury. She focuses a lot on design. I'm mainly capital, deal structure, and project management. So that's Oxedo Sedona. You can see this here. It's going to be 22 units spread across 5 buildings. And it's sort of just like low impact, low density nature retreat. The vibe is go there with your significant other. They're all 1-bedroom, single king rooms in this amazing view of the Red Rocks. Talking about identity, Mike, while I was getting that going, I wasn't really yet thinking about like expanding and doing any other developments. I was solely focused on Oxedo. But once I got into that identity of being a hotel developer, truly other opportunities just started to come to me. The Boulders is a family-owned property owned by that family office that I mentioned that invested in Sedona. And when I pitched them on my concept, which even before Lauren came on was more so tiny house, stable structures, it was definitely nicer than a glamping retreat like this. They were just about to open this property. They had these units furnished. They had them photographed. And I pitched them on my concept in Sedona about 2 months before they were set to launch. And they said, we'll stop doing this if you come down here and develop this concept on our property. So this is a fee development deal of mine. They hired me basically, I call it project lead because I basically span creative, project management, concepts, everything all the way through, sort of quarterbacking it for the family. We are finally starting construction next month. The permitting has been a nightmare, 18-month permitting process with this county in Arizona. But this was my second deal. I was living out in Arizona for 2 years in Scottsdale, going back and forth to Sedona, and this is in between Phoenix and Tucson in southern Arizona. That's what it's gonna look like. You see, these are all single queen units with a living room and kitchen. There's gonna be 5 in the first phase, and then full phase 25. And then Hotel Pearl is an interesting one. So I went to college in New Orleans at Tulane University, and while I was there, one of the best things for my career, I worked at a real estate developer, just 4 partners and me. I was their first hire, similar to Align. Small partnerships, I think, are the best way to get experience. And while I was there, we were doing Airbnb, or they were. I was sort of like filing receipts and doing whatever they asked me to. And we saw that Airbnbs in New Orleans, people were paying more per bedroom than on larger units than on smaller units. And that's really an anomaly because typically, if you're traveling to a city with a group of friends and you're staying all together, you're like talking about how you're splitting the cost and you're wanting that cost per person to come down. In New Orleans, there's such a shortage of large units because it's a small city, there's not many condos. All the large 4 or 5 bedroom housing units are these big Victorian homes, kind of in the more suburban neighborhoods of New Orleans. So the supply is really low, but the demand is really high. When I was growing up, we did our family reunions there. Bachelor parties are really popular. Conventions, Mardi Gras, Jazz Fest, it's a city with a lot of parties. There's a lot of groups, there's not a lot of group stay units. We saw this. We wanted to just basically take it from individual STRs to a larger hotel concept for all the operational advantages and things that Mike and Blake talked about today. That project started in 2018 when I was working for this group, Urban Properties. I obviously left when I graduated school, stayed in touch with Urban Properties, got involved with Align. Urban Properties got this property under contract. They held it under contract for like 3 years, kept extending through COVID. And in November of 2021, talk about finding the capital before you find a deal. They were just searching for capital for 3 years. By this point, I had established a relationship with Align. They had put up about $250,000 of the $2 million on the Sedona deal. I basically brought Align and Urban Properties together to do Hotel Pearl, got my small seat at the table, put some money in myself, and we started design and development of Hotel Pearl, which is going to open in about 45 to 60 days. It's a large format group stay hotel. So there's 10 units. Each unit has anywhere from 2 to 7 bedrooms. Across the 10 units, there's 46 bedrooms. So on average, 4.6 bedrooms per unit. Every suite or unit has a living room and kitchen. So it's basically like a condotel, but the difference is concepts like Sonder or others that have done the apart hotel in the past, they just basically took apartment buildings, maybe slapped a brand on it and started operating them. What we wanted to do was create a sense of place, a brand. We invested heavily in brand. We invested heavily in design. We hired these great designers from Soho House. There is a lobby. There is a bar restaurant. There's a pool terrace, a pool bar. Everything about it's going to feel like a boutique hotel, but just these large format units. I think it's the first in the States. There's someone in Austin doing something similar called In Cahoots. That was my third concept. Here's a picture of the living room at the Hotel Pearl. And then the Driftwood Motel, my partners, Urban Properties, they found this really awful motel in Bay St. Louis, Mississippi. on the coast. They bought it for about $1 million. I was working with them on the Hotel Pearl, and I basically asked them if they wanted me to run point on it like I'm doing on Boulders. So this is my second fee development deal. I did everything from creative, project management, helped them secure the loan. Most of the equity financing we raised from an existing pool of investors that Urban had connections to. I think it was about 450 in equity and the other half in debt. And we renovated this over the course of 8 months. It was very quick, very scrappy. We spent like less than $2,000 per room on furniture. The left side's a video, but it was a shithole. There was overdoses. It was a drug den. It was a bad place. And one of the coolest parts about this project is the city was so happy that we were just doing something with it, that the amount of support we've gotten, it's incredible. I honestly think about, like, for all my next deals, finding these environments where the community will actually get behind you rather than like Sedona, where we've had to actively fight, I think is a big point to be made. But there it is, the finished product on the right. It's 27 rooms. There's 4 unit types, but pretty simple project, faster. Like I said, that was the last project I started. It's the first to finish. Oxedo was the first project I started. It will be the last to finish. One thing that I like to talk about, and it bleeds into raising capital, is how are you going to have the patience to be texting your high school connections, your country club connections, having these conversations, planting the seeds, spending your time finding the ideal deal when you have bills to pay, you have families to pay for. That was a thought of mine, because when I had this early experience at Urban Properties, what I saw was they were developers. They left development shops, the 4 partners that they were at previously, to start their development firm. But in order to pay for themselves, their lives, and grow a team, they needed an operating business to support that. If you're getting into development to scale and do multiple projects and not, sink yourself in and operate one project, you have to think about how are you going to support yourself, your team, and scale. And development itself is a really flawed business model. Like, this is a chart that I've made just about my own self. In the run up to Sedona, until I raised that first capital, there was probably 12 months where I wasn't getting paid on it. And then when I raised the capital, I got fee revenue. And that fee revenue is great. Development's great. You get these big windfalls either from fees or refinances or sales or once you hit a promote. But they're so far spread apart, it could be months or even years. I saw that early at Urban Properties. I noticed it right away when I went out on my own. And so I started thinking about how can I solve this for myself so I can be more patient and spend the time sourcing and raising capital for deals in the future. Companies like Urban Properties, what they do is brokerage, project management, and property management. I'd say is very common for real estate developers because obviously it's real estate adjacent and there's a bunch of tangential benefits, like obviously your brokerage and project management clients can become partners and bring you deals and whatever. So it makes sense, but the problem is they're high personnel, they're geo-dependent, so you're pretty locked in on a market. I wanted to be pretty mobile, hence traveling in a truck for a year. So I wanted to do it differently. I wanted low personnel, high margin, reach and scale. And I tried a number of operating businesses, but ultimately started DealPage, which is a capital raising software. Essentially what it is digital pitch decks. What happened is when I was raising capital for Hotel Pearl, I spent like 4 months on this deck. I spent the whole summer, just crushed myself on it. And obviously it worked. We raised $5 million in equity for Pearl, largely from high net worth investors. Average check size was like 250 grand. I'm sorry. Can someone grab me water from the team? I hate to be like a diva, but I'm like dying up here. Thank you. And I get to the end of this 3-month or 4-month process making this deck, and I look at this thing, I'm like, this is so boring. This could be so much better. And the process to make it's awful. We've all probably used PowerPoint here. So I started DealPage, and it's interactive pitch decks, which we'll come back to later. But that is how I've supported myself in my development. That's allowed me to be patient on things in between fee payments. Fee development is also another good solution. Basically, you don't take ownership and you're developing for a fee, a project management fee or creative direction fee, whatever services you're sort of rendering. So on the capital raising front, there's 2 things that I typically talk about. It's fundraising systems. So I learned a lot at Align. Doing so many deals, we really dialed in the back end of how do you find investors, store them, keep track of them, reach out to them, intake them, get them signed, get them funded. And then the other thing is, in order to build DealPage, and I still do this, but since the beginning of my company, I've offered deal advisory, pitch deck writing services. So At this point, I've probably written over 150 decks, raised over $220 million. I have a pretty solid framework for how I like to write decks and present deals and how to think about deals. There's those two things, and then the other thing is active investor relations, which sort of gets into the question that you had right there about, do you raise money first or do you find a deal first? So I'd rather just open it up to the crowd and hear what you guys would like to hear most about raising capital. Is it how to write great pitch decks? Is it how to build a stable investor base or an investor pool to pull from? Or is it the actual systems and processes of going out and raising capital? Even like deal structuring, how do you structure deals, GP, LP? What's most important to you guys? In what order? Okay, that's one of my favorites. I wish I had a whiteboard. I like to think about deal structure. You have your project, you have your deal, the water cup, and above the hotel, the Tremont Lodge, you have a project entity. This project entity is an LLC. That's what you're raising capital into. The LP investors come in from the right-hand side over here. They put in capital. In return for capital, they're entitled to the cash flows from the project. Above the project entity, you're going to have the GP manager entity. That's where you sit as the sponsor. You and your GP partners are up above this entity. This is another LLC. In the project entity's operating agreement, the GP manager is the manager of the project entity. So however you make decisions at the GP manager entity level, those decisions that you make trickle down to the project entity. You decide what terms to set on the deal when you bring investors in. You decide what to spend the money on, how to spend the money, pretty much all the decisions for the project, unless LPs negotiate and get more voting and decision rights back to them. But we'll put that aside. The simple structure is project entity, GP manager entity, LPs are coming in over here. A few distinctions I like to make. Who understands promote structures, preferred return and promote structures? Okay, so the way that GPs get paid is through a promote, which is essentially like a profit share. Who's familiar with hedge funds and how they make money? No? In almost any investment business, like a hedge fund, private equity, real estate, the way you're making money is on a promote or a profit share, where above a certain return, typically, the GP is entitled to part of the cash flows or profit, and that's set at the deal term level. So a simple example of this is I'll just use Oxedo. On Oxedo, the terms are, once the LP investors get their return of capital back, which is like table stakes, they need to get their money back paid first, plus an 8% preferred return. So 8% on their money for every year that their capital is outstanding. As you're paying them their money back, their capital account is drawing down. So it's not 8% on that initial balance. It's being drawn down over the years. But it works out to be 8% annualized on an 8% IRR. Once they get that back, above that 8%, we're going right to a 60-40 split. 60% of every dollar that comes out after that 8% preferred return goes to the LP, 40 cents goes to the GP. And that goes on in perpetuity for both cash flows and financing and sale events. Now, there's a lot of nuance to this. Typically, number one, the preferred return, that 8% can change. It can be 0 if you're really experienced. It can be 12. It can be 15 if you're less experienced. But you have that preferred return. That's the first negotiation point. And then the actual split that comes after that, that can be negotiated. Typically, people will do waterfalls where basically as you pay them back more and more money, it gets more heavily weighted back to the GP. So if you achieve really high returns, you as the sponsor, this is your sweat equity, you can make more money basically as you pay them back more. One distinction that I like to make, sometimes people will cheat. GPs have to put up equity capital almost always. Typically it's 5 to 10% of the total equity to be raised. That's so investors can see that you have some skin in the game. And sometimes people will treat that GP capital different, where that GP cash capital is not subject to the same return of capital and preferred return as the LPs. I like to look at it like you as, let's say it's you and your wife or your husband, you're the two members of the GP manager entity, and you're fulfilling your sponsor commitment, expectation of 5 to 10% by putting this cash in. That cash should be treated the same as LP capital. If you put in 50% or 60%, whatever it is, that's treated the same as LP capital. So you sort of have to distinguish yourself, like your role as a GP and sponsor, in the same way that the LP is getting cash flows in return for putting in capital, you, the sponsor, are getting fees, typically an acquisition fee and a development fee. Maybe those are the standard fees that I've seen at least on these deals. sometimes a refinance fee, maybe an asset management fee, but you're getting fees, and then you're getting the promote in return for sourcing the deal, structuring the deal, and basically managing the development. So it should not be conflated with your returns on your cash. That should go in through the LP vehicle or under the same structures as the LP. In the same vein, what's allowed me, what's been very beneficial for me personally, if you're doing any role on the project outside of what's typical of a general partner, such as, for me, project management, creative direction, brand, interior design, those things should all be charged to the project entity at market rates. Anything that you would otherwise be hiring out to a service professional, and sometimes you see GPs, they're like, I want to be scrappy, I want to show my investors, like, I'm in this, I'm just going to do it all. I don't think that's how you should do it, and I think it holds you back, and it puts you more in that hole of the flawed business model where you're waiting for these fee payments and these refinancings and these pref and return hurdles to hit over time. So that's how I think about structuring deals. And if you manage the property, in hotels specifically, typically there's a management entity set up. That management entity is going to charge a management fee to the property. Typically in hotels, I've seen 3 to 7% of revenue or 10 to 20% of profit, net profit. And if you, the sponsor, are also managing the property's operations, that should be separate. That should not, your payment should not come from the promote. So I like to really separate it into what value is going in and what's coming out, and remove it from yourself as an individual. And that's how I've structured all my deals.
Would you say after we exchange for good some of the branding and private man that's all about?
Would I? No, because I've been focusing more on cash and like growing and starting my business and growing a team. The way I've gotten equity, like on Sedona, I mean, relative to the other partners, I've put in such a small amount of capital, but the way I got my equity on that was finding the deal initial. I like to think about it in development. There's idea, execution, and capital. And when you're early on, you're not going to have much capital to bring to the table, but what you can bring is idea and execution. Problem is, not a lot of people are going to listen to your ideas a lot of the time, so really execution comes in. So like going out into the market and finding the land is the first place where you can execute, where you can get some leverage for yourself. Getting the permitting and entitlement done, putting together the plan, even just simply like packaging the deal together, setting the plan outright. Like that's all I did on Sedona. I was just the one to do that, and that got me the seat at the table that I wanted.
The GPs also personally guarantee the debt, so shouldn't feel bad to be taking 60-40 spring of ownership.
Well, there should also be a guarantor fee if you're doing that. Yeah, lots of fees. Yeah. I haven't guaranteed anything, candidly. I can't. I don't have anything to guarantee. But we've brought on partners specifically for that in certain deals too. So, like 3% of the amount guaranteed in cash, and then anywhere from 10 to 20% of the promote. What I've seen. No, 10 to 20% of the promote. Yeah, yeah. I think on Crexy they have like guarantor. They broker guarantor deals too. And there's people out there. There's one guy I met. That's all he does. He just guarantees deals. He's made a ton of money doing it. So that's structuring deals.
Can you talk a little more, like in a little more detail about structuring if you're bringing the deal to the table, which you might not be very capital heavy at the moment, in order to get one of those positions at the table?
Yeah, that was like Oxedo. I'll just speak candidly. I'm not like, basically on Oxedo, I had this idea for this campground. I went to a line with just a pitch deck. I went down to meet them for dinner in Miami. They mentioned they were interested in glamping. I made a pitch deck that night, came back to them, and I was like, hey, I want to do this. They said, sure, if you can figure it out, we'll help back it. And the process basically went, I started looking for land around the country. I would look on Zillow. I would then go to the county's website, look at the zoning, and it was this endless process in Google Sheets of putting in links to properties, putting in the zoning information. It was a nightmare. If you know anything about zoning, this is a ground-up project. The zoning, I'm still learning things about Sedona zoning 3 years later. It's always so nuanced. And I just realized, I'm like, okay, sure, I may be missing out on this diamond in the rough market, but I cannot manage this just looking across the whole country. I need like an in. And I said that to a line, and they're like, oh, we know this land family in Arizona. We should at least go talk to them. And in preparation for that meeting, I was flying down there in June of 21. I just did a ton of research focused on Arizona. I wasn't that focused there yet. And I realized Sedona by far and away was the best market 3.5 million visitors per year, only 10,000 full-time residents, not a ton of supply, high regulation, but I figured that was the best market. I put together a new deck. By this time, I had been going out west and touring a bunch of like glamping properties. No offense to any glamping people here. It was not what I wanted to do. I was really worried about regulation, about longevity, about the trend. I had shifted my concept by then to this more stable, solid structure that I mentioned, put that together in a deck. We met this family. We toured the boulders. We went up to Sedona. We went to a Mexican restaurant. I pitched them at this place. They liked it. They said, if you can find land, we'll invest. And that's when they brought up the boulders for the first time. And this is actually what's really interesting about this deal. So Align Ventures is a venture capital group. They're very well funded, very well resourced. When they got the commitment or the initial soft commitment from this family office, they started to bring in people around me that were much more experienced than me. Understandably so. I was 22 or 23 at the time. And I was fine with this because I had no clue what I was doing. And we tried to get this deal going remotely. I was in Boulder. One of the guys was in Chicago. Another one of the guys was in New York and then Miami. And the deal within 2 months was falling apart. If you're not in market, if you're not committed, I don't think you can source land and do ground up deals. And the deal was going to fall apart. I remember we were on a phone call in July of 21, so just like a month or two later from that initial visit, and everyone was sort of bowing out. And I was like, hey, I'll move down there. I'll go make this deal happen and find land. I had a van. I'm like, I'll go, but terms need to adjust to reflect that. And I took the risk. I moved. I lived in a 1-bedroom Airbnb without a kitchen. It was a bedroom and a bathroom for like 4 months. I was living in my van. I was going back and forth to different towns around Sedona just looking at land. All the while I was doing pitch decks and financial models. You just get compensated for the risk in putting yourself in those situations. And eventually we found this piece of land. It was on Zillow for 2 years. Like sometimes you find these diamonds in the rough. I brought it to Align first. They were interested. I packaged it up, brought it to the family office. We got it under contract. Did 6 months of diligence. And over this whole time, I was continuing to have to fight and advocate for myself. You know, Align, they're friends of mine and partners. We're partnered on the Pearl. We'll probably keep doing deals together, but it's business. They want the best for them. And honestly, I don't blame them. Putting up capital into anything deserves much of the ownership. But the biggest thing was just constant phone calls and just fighting to get what I could. And then eventually got the investment and got the land. And there's been a lot more shifts and changes over the time, like bringing in Lauren. Things had to change on the cap table. She's not putting in capital, but she's bringing in so much experience and execution and credibility with her name and her property. But I would say if you don't have that experience, it's ideas and like taking the first steps are going to get you the most as far as equity.
How do you have the conversations around adjusting the cap table? Or like, because a lot of us are short-term rental folks and we're like, we're going to own our houses, we're going to be independent, we're going to do this. How do you mindset shift to we need to spread and like share and give people access to equity in different parts of this deal?
I've gotten better at this over time. I mean, at first it was just fight like hell, which is not what I would recommend. Some things that I've learned. The family office that I work with has been a great lesson for me because they are very powerful. They're very slow moving. They hold all the leverage in almost any situation I've seen them in. And the things I've learned from them are let the paper talk. Don't get into emotional phone calls and go back and forth. That's not going to change anyone's mind. Let red lines on operating agreements and contracts going back and forth do all the talking as much as possible. It takes the emotion out of it. It makes it much easier. The other thing that helped me at a certain point, we were really hitting a sticking point, and I just pulled together all of the things that I had done to date and then listed out in as extreme detail as possible all the things that I knew to be coming around the corner and whose responsibilities were what and how compensation was shaking out. And again, putting that down on paper and pushing that across the table and being like, okay, if I'm not getting compensated in this way, who should we have do this? And let's go out in the market and see what that costs cash-wise. And do you guys have the cash to pay for that? And just make it about numbers and words on a page. The other thing is move slow. Again, why the operating side of the business is so important. If you're rushed, which I totally was on Oxedo in the beginning and Hotel Pearl in the beginning, you're screwed. The people who can move the slowest and be the most patient usually win. So finding a way to stable your ship and know that you're going to be okay for, these deals take months and years. That will greatly increase your chances of getting what you want out of a deal. What I want to jump to, this is something that I haven't gotten down. This is a presentation I've done before. I sort of have these things I like talk about. Something that's newer and that's come up with what you were bringing up with finding a deal first or finding investors is something I call active investor relations. And give me some grace. This is something I'm still like mulling over and executing on within my business. But I want to tell a story. A year ago, so I'm 4 deals in at this point, and a year ago, my partners and I on the Pearl went out and tried to do a deal in Poplarville, Mississippi, which is not that far from here. It's in southern Mississippi. It's not a vacation destination. People in New Orleans have like farmhouses there that they go basically stay at. And we found this amazing family antebellum like property, this huge 370-acre piece of land, this big old house with 10 rooms in it. And we wanted to do like basically the southern version of Oxedo. And in about this time last year, we started the process of putting this deal together, which included putting money down on the property, paying some consultants to do some of the market data and intelligence, underwriting it, putting a deck together, and then going out to market. And if I remember the timeline correctly, we had 45 days of a contract period initially. We started having investor calls. We had probably 60 investor calls. We extended by 30 days. So over the course of 75 days, we had 60 investor calls. We extended because when we got to the end of the first 45 days, we didn't have the money raised. And at the end of that next contract period, by this point, we were hard on the land, 35 grand. We probably had 15 grand in other soft costs in legal and data into it. And we get to the end of the total 75-day contract period, and we're $750,000 short. And we didn't come up with it, and we lost the deal, and we had to let it go. We had to let our hard money go, and that was the end of that project. And I remember being so frustrated because I wouldn't call it luck, but I've had most of my deals like come together one way or another since I started. And this was my first big like punch in the gut. And the first thought that came to my mind is like, fuck this. Like next time I do this, I'm going to do whatever I can to stack the chips on my side of the table so that I have the best chance to get the deal done before I even go out and start raising. And I started to think a lot about last year, how can I do that? And I started to think a lot about my experience at Align. I'm like, all I know, this is the other reason why I was so upset, because when I was at Align, we'd get a deal, we'd go to market, we'd get it raised. $5 million, $20 million in 10 days. And we get the money all wired in within 24 to 48 hours. And I was like, okay, what do they do? How can I do this differently? And one of the things that they were best at was forging and fostering and then maintaining relationships. So we had this pool of LPs, and the partners, their whole job was really to go out and forge and maintain those relationships. I was sort of running the back end of Align, and they did that the old-fashioned way, you know, going out, having dinner, shaking hands, meeting people, and then staying in touch. And I think Align was pretty far ahead of the curve when it came to that, just as far as like engaging over email, sending these like pseudo newsletter emails out. But that was the extent of it. And this was right around the time last year that I really blew up on social media. When I started Driftwood Motel, I started posting videos of my process and progress there, and they started to get a lot of traction. And that's when I really started to think about like, okay, how can this be done differently today? Like the world has changed so much. We have social media, we have technology. How can I try to achieve what I've seen done with Align and other groups in basically managing investors and investor relations, active investor relations? I think the 2 ways that I think about doing it right now are social media, one to many, and then one to few in the form of mainly email, one-to-one or one-to-few, like an email list, and just engaging with people. And I think a huge advantage we have in real estate, like when you have active projects like I did with Driftwood, there's a tangible visual process and progress there that you have to show. Even if you're awful on camera, you have no idea what you're doing, you have this thing that is changing and taking shape over the course of time. That's a huge advantage. And there's a lot of residential stuff online as far as real estate on social media. There's not much commercial. And I think there's a huge blue ocean there to be making more content. But the problem is before you have a deal, what the hell do you talk about? And really when I started on social media, I had gotten to a pretty substantial following just by showing literally camera on me and then flip it around and show the financial model and explain like this is why I'm doing this and here's a map of this market, this is where I think I want it to be. And just providing those updates. I haven't gotten an investor through social media because I haven't tried to raise a deal, but I do know that most of my investors for the rest of my career are going to come through social media. I've made connections with massive family offices, $400 million family office, $2 billion development fund. And what's the craziest part is it's not like the social media manager I'm connecting with there. It's like the CIO or the partner. All of these people are on TikTok. They're all on Instagram. it's hard to get started. I remember feeling so uncomfortable with it in the beginning, but it's such a powerful tool. Almost every day I ask myself, why am I not leveraging it more? The other thing that's easier to start with and that I actually prefer is just email and just building an email engagement list, a list of people. I have like 2,000 people on mine. Most of these are like close friends. This is not internet people. These are like friends, colleagues, people from my past. And I'm just constantly updating them. Like the other day, I sent out an email with a video of the driftwood, just with what the rooms look like today. And I need to be doing it more, but just sending out, even if you don't have a deal done or in progress, like, hey, this is where I'm at. I'm looking in these markets. This is how I'm progressing. Making the statement of, I'm going out. I'm looking for a hotel deal. This is how I'm approaching it. Sharing your approach, sharing your failures. Almost all my investors that I've brought into my deals personally, whether it be Exito, Pearl, Driftwood, they're all people who have taken an interest in me, in my journey, more than my deals. And I think that's the case no matter who you are and what stage you're at. People invest in people. Sales is about people. And showing your failures and vulnerabilities in the raw process is a really powerful thing. Like I use DealPage. I write these company updates. It's essentially like a blog. I'll post it to my Instagram story as a link. I'll post it on my LinkedIn, and I'll send out an email, and I can share some of these with you. But typically what I'm talking about is like the nitty gritty of like financial models, design planning, and then when I have deals under progress, showing progress and explaining why I make the decisions I do, and letting these people know who I am and what I'm about, so that the next time I go and try to do a Shangri-La, which was the name of this Mississippi deal, it's not a question of if I'm going to get the deal done, it's who do I want to invest in my deal. So however you want to do it, I would say, yeah, like Mike mentioned, the first thing I ever did was I sat down with a Google sheet and I started putting in names, and I went through first degree of separation, like Mike said, high school, college, past colleagues, family. Then second degree of separation. Okay, I have an uncle who's an exec at Boeing. Who might he know? Ask him. Hey, I'm starting to look for hotels. I want to do this deal. I'm going to be sending out emails. Uncle Mike, can I put you on this email list? Obviously, he's going to say yes. Start sending the emails. Uncle Mike, what do you think of the emails? Oh, I love them. Do you know anyone else who would want to read these? Like anyone else who might be interested? And build out that way to second degree connections, third degree connections, and on. Another example, we were searching for a PR company for Pearl. I did a bunch of reference calls with these PR companies' clients. I met this one guy who's a massive developer in New York City, and I asked him, at the end of the call, we talked for 30 minutes, he had decent rapport, nothing crazy, I didn't know him before. I was just like, hey, I send an email like about every month, and I put you on this list. Now he's on the list, he just got the video of Driftwood, I saw that he watched it, and that's how it goes, just one at a time, and you'll be astounded. Like I said, I saw a good thing online where people are like, oh, people get discouraged because they post a video or they send an email, and they're like, oh, only 300 people saw this. That's triple what's in this room right now. And it's not about the numbers. Like my 2,000 person email list, I feel more confident about than anything, than my social media following, which is hundreds of thousands. It's about those single individual connections. And I would honestly maybe even probably prioritize the micro, the email list, before jumping into social media if that's not something you're comfortable with. Any other questions? All right. That's good? Yeah. 2 minutes. I have one more thing I want to share. This is one of the things I love the most. So when I think about writing a pitch deck, this is one tangible, tactical thing I want you guys to take away. What I see a lot of people doing is they'll take the deal, they'll take the Tremont Lodge, and they'll go out to market and they'll say, hey, this is the Tremont Lodge that I want to do. It's going to make this much money. We're going to do this, this, and this in the renovation. Do you want to invest? And frankly, at the scale that we're at and with the investor connections that we have, I've never seen that be successful. The deals that I've seen be the most successful are those that attach to a narrative. And the way that I think about creating this narrative, the thing that I do on every deal that I write is something I call macro to micro. I'm not going to follow this because I'm just going to cut right to it. The most powerful thing you can do after what I call setting the table. Setting the table is like introduction, executive summary, here are the terms. It's everything I just said, like here's the deal, this is what I'm doing, this is how much money it's going to make. Then you need to step back and zoom out. And the way that I think about it is zooming out to the most macro or the broadest context that is relevant to the deal at hand. So in a lot of deals for us, it's going to be the industry level. So going back out to the hospitality level and thinking about what are the trends, themes, opportunities, and things that are happening in hospitality that are relevant to this deal. And then you move from the most macro context down one level of context at a time. So that's going to be hospitality industry, maybe it's market as in the region, the town, the specific location of the deal, and then the most micro level, which is the deal itself, and then you, the team, executing on the deal. And I've really, again, this is one of the things that's sort of like work in progress for me, because I'm just doing this on every deal I write and I bring to market. But what I think is so powerful about that, like a tangible example is on the Hotel Pearl. We talked about how the advent and proliferation of Airbnb, which really came into market around 2015 and ramped up from there, by 2019 overtaking Hilton and Marriott in sales, that sort of seismic shift in that period of time is not going to not have massive ramifications on an industry. I remember I made this graph that showed like traditional hotels for so long have been up here, vacation rentals through the 90s and early 2000s were an industry, but a very small one. When Airbnb brought a platform that brought it to scale, that started to ramp up and it started to converge with hotels. Things are not going to continue as normal from that point forward. So what are the things that are going to happen? When you explain that to anyone, like you guys are nodding your heads, you're like, oh, of course, what are the offshoots of that going to be? And that's where we start to get into, well, one of the things that's happened in the industry, people were exposed to new options, new operating modalities in hospitality, such as tech-enabled check-in, staying together as groups, staying together in more remote locations out in the wild. Okay, those are the opportunities that are being created. What are we going to do about it? We honed in on the group stay, obviously. Then we move down to the next macro level, which is the market in New Orleans. We say, of the group stay markets in the country, New Orleans is one of the best because of this, 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 and this. In the city of New Orleans, one of the best places to be is right here, St. Charles and Julia. Superdome's right here, World War II Museum, Convention Center, all the places where these groups are going. And we're moving down until we get to the Hotel Pearl, where then we're saying, we're going to do a group stay hotel called the Hotel Pearl. We're going to do it this way. It's going to make this much money. And when you move down macro to micro like that, you're creating momentum through the rhythm of telling that story. You're literally moving downhill and rolling downhill. And the way that I like to think about it, you're not positioning your deal on a pedestal, and that's like the crux, where the investor has to look at that and be like, yes or no, is this a good deal or not? You're creating a gap. You're telling the story, and you're sort of like leaving a space where it's like, this is happening in hospitality, this is happening in New Orleans, there's a need for this, or there's an opportunity for this, and you define that to the investor, and then you just position your deal in there as plugging the need, or solving the problem, or answering that opportunity. And it becomes less about judging your deal for just the deal's sake. The investor is now like, yeah, you know, I agree with everything you just said, this makes sense, this is what needs to happen. And taking the pressure off your deal and making it about the bigger picture, I've found to be successful. And then the other main part of this is when you're doing all that, the other thing that you're doing is establishing authority. Because you're presenting new information, or you're presenting common information, but in a well-articulated manner, the investor is coming to trust you. You're a source of authority and knowledge on the topic. And when you do finally get to the deal, and then you get to yourself, the team bios, and the track record, you've built up so much authority and trust already. So that's my biggest, I wanted to have one thing that people could actually like act on. That would be the biggest thing. The other would be start sending emails to people in your life, telling them what you're doing, and keeping them updated. Thanks, man.